Okay, generating a 30% return on operating assets sounds completely fake when you're talking about a used car dealer. Welcome to Earnings Unscripted. It's July 29th, 2026, and today we're unpacking Carvana's second quarter for ticker CVNA. Honestly, Miro, my first thought reading this was just, how's this the same company from a couple years ago?
It really isn't. The machine they built is firing on all cylinders now. Top-line revenue grew 52% year over year, which completely blew past Wall Street expectations. They're moving metal at an incredible scale.
Right, and they actually turned a solid profit. They posted earnings of 42 cents a share. But here's the paradox. They crush the estimates, the operations look great, and then the stock just gaps down hard immediately after the bell. It finished extended trading well in the red.
Yeah, the market didn't like something under the hood. The intraday action was super volatile leading up to the print anyway. But honestly, the sell-off feels a little backwards when you look at the fundamental tailwinds they just got handed on a silver platter.
Oh, you mean the FTC ruling? That was hilarious to read. And before we get too far, remember, we're just analyzing filings for entertainment. None of this is actual financial advice. But that regulatory change is wild. The government forced legacy dealerships to bake all those hidden dock fees into their advertised prices, right?
Exactly. Carvana never charged those junk fees. So overnight, all their competitors have to show higher sticker prices on the internet. Carvana didn't even have to change a thing. And suddenly they look like the most competitive option out there. It's basically a massive zero-cost marketing campaign handed down by federal regulators.
Regulatory relief disguised as pure luck.
Pretty much. But investors are ignoring that today because I think they're spotting a big caveat behind that massive revenue growth.
Right, except before we even get to the revenue accounting, there's something totally bizarre going on with their share count. I was looking at their basic shares outstanding from last quarter compared to this one, and the math just fundamentally breaks. Did they secretly split the stock without telling anyone?
Yeah, I had to double-check my own math on that. If you look at their filing from last quarter, they reported their year-end basic Class A shares at roughly 142 million. Now, in this new 8K, that exact same historical figure is retroactively listed as over 711 million.
Okay, so a clean 5-to-1 jump.
Right. The math demands there was a phantom stock split somewhere in the dark, but the actual word split never shows up in the release. It totally warps the baseline for earnings per share if you're not paying attention.
That's mildly terrifying if you're just skimming the headlines.
It gets better because the top-line revenue growth is also distorted. Management openly admitted they got a massive bump from a one-time change in what they call their gross revenue treatment. And that accounting benefit expires completely next quarter.
Okay, wait, slow down for a second.
Gross revenue treatment.
Are they just changing how they book the final sale price, like acting as an agent versus the actual seller? How does that artificially inflate the top line?
No, that's not quite it. It's more about how their shift towards much more expensive, newer inventory combined with the traditional accounting flow to decouple their revenue growth from their physical unit sales. It's complex, but like you guessed earlier, investors spotted the cliff. Mark Jenkins basically warned everybody on the call.
Did he say how hard the drop-off is going to be?
He phrased it carefully. Quote, "The gross revenue treatment change will no longer affect year-over-year comparisons beginning in Q3. We expect revenue growth to be more in line with retail unit growth in Q3.
Oh, okay. So if retail unit volume only grew in the high 30s, but top-line revenue looked like it grew in the 50s, people expecting revenue to stay at that altitude are in for a nasty shock.
Exactly, but honestly, the real story isn't the top-line illusion, it's what's happening underneath, specifically in their financing segment. Their other GPU, the gross profit they make per unit from loan originations and warranties, actually contracted.
Right, it dropped almost $200 year over year,
Yeah.
which is normally a giant red flag for a dealership.
Sure, but they intentionally sabotaged it
Okay, you're going to have to explain why a business sabotages its own profit margin.
to buy market share. They essentially took over 100 basis points of interest rate savings and passed them directly to the consumer instead of pocketing the spread. So the upfront financing profit shrinks, but they unlock access to a vastly wealthier demographic. Ernie Garcia laid this out pretty clearly on the call. He said, quote, "If we look at customers with over $100,000 of income, our year-over-year growth in that segment was a little more than 60% year-over-year. That's showing you that when the cars are there for that customer segment, the growth is there."
Wow. Okay, so they swallowed a short-term hit on the financing desk to aggressively poach the premium market from legacy dealers.
Right. The fundamental operational gains per car are still compounding. They just masked them with subsidized loans. You squeeze your own margin to suffocate the competition. And we know it works because when they build local capacity, the sales instantly follow. Look at their Midwest and Northeast expansion.
Right. They opened up a bunch of those newly acquired Adisa physical sites there.
Once those went live and local inventory jumped 57%, sales in those exact regions spiked in almost identical lockstep. It's definitive proof that their biggest growth lever isn't online marketing, it's literal physical proximity. If the cars are local, people buy them.
But that whole strategy depends on actually having cars processed and ready for those buyers. And didn't Garcia basically admit their reconditioning engine was starting to choke under the pressure? Like they're physically struggling to feed the demand they're creating.
He absolutely did. It's a genuine operational bottleneck. They spent years, ruthlessly right-sizing their labor force just to survive, and now they actually need that throughput back. Ernie literally said on the call, "If we could write a check and have the machine be bigger, it would be very straightforward that we would want to do that at extreme speed. The demand is there, but the wrenches aren't turning fast enough."
Which is a great problem to have if you're a startup. But when Wall Street expects massive growth, choking on your own sales pace is a huge risk. So, how are they forecasting the rest of the year if supply is dragging?
Well, despite the constraint, they actually expect retail units to climb sequentially next quarter, which is kind of wild since the used vehicle market traditionally cools down hard in the back half of the year. And management clearly feels confident because they bumped up their full-year adjusted EBITDA guide to somewhere between $2.7 and $3 billion.
That's a serious pledge. It really just comes down to whether they can physically process enough inventory to meet their own ambitions. Because looking at their overall trajectory, they aren't aiming for modest growth anymore.
No, they're aiming for total dominance. Garcia floated a midterm goal of eventually selling 3 million cars a year. He told investors, quote, "The good news is when we build that big machine, there's a big moat behind us that nobody else wants to run across."
I love that. Basically saying we spent billions learning how not to go bankrupt, and good luck to anyone trying to copy our homework.
Exactly. The physical infrastructure is the ultimate defense.
Well, it's going to be fascinating to watch them try to scale that machine without breaking it again. Always a fun one, Miro. Thanks for digging in.
Always a pleasure. See you next time.
If you want to catch our next deep dive, you might want to keep us in your podcast feed. Just remember that everything you're hearing right now, from the script to our voices, is a completely synthetic AI experiment built to process huge SEC filings like that Carvana AK and ship an episode the exact same day. Feel free to let us know which ticker we should tackle next by dropping a quick note to earningsunscripted@datamadness.ca.
Thanks for listening.